if I have 150 clients, how many clients do you think I'm actually really focusing on? It's probably 30. Maybe 20. What happens to the other 100? Are they really getting the opportunities? Are you really spending time going deep in what's right for them? You might say yes, but it's just humanly almost impossible to do. But technology allows that. The technology can say, hey, Ripple Ventures, I as the wealth advisor approved it. Oh, I have 72 clients that it should fit in their portfolios, and here's why. Here's what it does to the risk return. So what we try to do is improve their revenue, decrease their costs, and by doing that, we allow them to do the things that they're really good at, which is spend time on high value client activities where they can spend time with the client talking about the entire picture and again, creating those better outcomes.
Welcome back to Tank Talks. I'm your host, Matt Cohen, founder and managing partner of Ripple Ventures. And we've got a special episode today with a true industry veteran and innovator in the private markets with my friend and fellow podcaster, Samir Kaji, co-founder and CEO of Allocate. Samir has been in the VC game since 1999, starting his career in venture banking at institutions like SVB and First Republic, where he advised over 700 VC and PE firms. He's also the host of the popular Venture Unlock podcast, a Kaufman Fellow, and a personal investor in breakout companies like Carta and Reddit. But today, we're focusing on his entrepreneurial journey with Allocate, the platform that is revolutionizing private market investing by providing essential infrastructure for fragmented ecosystems. Fresh off a major milestone, Allocate just closed a $30.5 million Series B round led by Portage Ventures, with participation from heavyweights like Andreessen Horowitz, M13, and Fika Ventures. In just 4 years, the company has scaled to over 2,800 users, $2.5 billion in platform assets, and more than 80 fund managers on the platform. They've even completed their first acquisition and built out 3 new core product lines: administration, execution, reporting, and origination, all aimed at solving the inefficiencies in private markets, much like how public equities were transformed in the 1970s. In this episode, we'll explore the wild ride of founding Allocate right before the 2022 market shifts, and the hard lessons on everything from eating unexpected glass as a founder to balancing personal identity with company performance. We'll dive into how AI is reshaping their plans, the importance of crafting a compelling narrative, and the challenges of scaling in a hybrid world. Samir shares his insights on navigating the AI bubble, where valuations are sky high, but the potential for $10 trillion companies by 2030 is real, and offers some advice for new investors building capital in the private markets. Plus, we'll touch on recent industry moves, like the Schwab recent acquisition for $660 million of Forge Global, amid the growing demand for pre-IPO shares, and the look ahead to what excites Samir most about the next 5 years in private markets. Now, let's jump into the tank for this week's episode with Samir Kaji from Allocate. Welcome back to the tank, Samir. Nice to have you back again.
It's great to see you, and happy early Thanksgiving.
Happy early Thanksgiving. You know, Samir, you and I have been friends. We started in the podcast game at the same time, and we're also going through that early days of building something that will hopefully change the industries that we are focusing on. We're talking about private investing, private assets, alternatives, all things considered. But for you, you've had a big milestone in your own journey building Allocate. Congratulations on your recent $30.5 million Series B financing led by our good friends Portage Ventures in Canada. You know, talk to us about how this has sort of culminated in this recent raise and the journey you've been on in sort of demystifying private markets and access to private markets.
So the origination story too, like why I created this company, started actually about 25 years ago. And thank you for, the kind words. It's really nice to get a fundraise done, especially with such a great firm like Portage, which, as you know, is also a Canadian firm. So like myself, I'm Canadian, so it was really nice to work with, fellow Canadians. But I started my career in the private markets 25 years ago. I was at a bank that unfortunately no longer around, Silicon Valley Bank. I spent 13 years there, really understood, the importance of the private markets. I saw all these great companies that were starting. I met Google when it had less than 90 employees. And, just being along the journey and the impact these companies were making, it just became very clear. So much value is now accruing in these private markets. And that continued to the point where in 2008, I moved to working with the sponsors themselves, like the venture capitalists. And at that time, you might remember, cloud and mobile had become a thing. And the world of, investable assets was so much bigger because now companies were able to raise smaller amounts of money and be able to kind of build, toward traction and affect pretty much every industry, whether it was fintech, whether it was manufacturing, robotics. And it became very clear to me around those 4 years that I was there, 2008 to 2012, that a few fundamental changes were happening. Number one, I was seeing the drop in new IPOs. I was seeing the number of funds that were coming to market to support private companies increase across all asset categories. So, private equity, private credit, venture capital. And what I also started to see was, people that were not big institutions wanted to invest in these type of assets. So these were high net worth individuals, as family offices, sometimes on a direct basis or sometimes through a wealth advisor. And I became kind of fascinated with like the change of the market toward more, private assets and the growth of that. And so when I joined another bank, and you're going to chuckle a little bit, which no longer is around, First Republic in 2012, I had this opportunity to kind of stand up a team really focused on working with private funds of all types, as well as the underlying companies. And the bank had a three-pronged model. The model was you bank, companies and funds, you bank the individuals that run those, and then you do the wealth management. So I started to see the both sides of it, capital allocators, so like our wealth clients, and I saw sort of the trends in the private markets. Well, today there's about 40,000 firms globally that run private market strategies. That's up about 5x from what we saw 20 years ago. And the number of people now looking to allocate has expanded by, over 15x. And in fact, by 2029, it's expected that there's going to be another 3 trillion in capital flows from the private wealth sector. The thing that I couldn't get and really didn't understand is why wasn't there a better way for the two sides to be able to interact? And there's a number of reasons, like GPs, it's hard to find families, it's hard to find RAs. It's even harder just to administer those smaller checks when they're not writing 5, 10, $15 million checks, but they might be writing 100,000, 250. And on the other side of the table, wealth advisors, to which there's 19,000 in the US alone, didn't really have a good way to programmatically offer this. I saw this firsthand at First Republic, um, let alone all these wealth advisor firms that may have 10 or 15 people that are trying to do this and need to cater to the next generation of clients by offering private. So Allocate was really kind of this, personal obsession of mine of there's got to be a better way for people to invest responsibly in privates. We need to use technology as a lever to allow wealth advisors to be able to build using our different sort of tools to offer clients a better product and in a way that's really responsible, which we can touch on later.
Yeah, it's so interesting. I think about this like dynamic first off of like what is a family office today? Like why didn't we have family offices like 40 years ago? Well, they were just wealthy clients that had money sitting at SVB or, JP Morgan. They got pushed up to the wealth management group and whatever products were on the shelf were typically the products that were offered to those families. It's kind of like the hotel business versus Airbnb, right? You could only offer the hotel beds in your hotel to those customers that walk in the door. But at Airbnb, you could offer anyone anything they are looking for specifically. And because of the opaqueness of the private markets, it's really hard to get access to those types of beds to plant your capital. And it's also hard to get the information back over a 5, 10 year lifespan of a fund. So what do you think is driving that? Is it supply and demand? Because yes, there's more wealth in the world, therefore there's more family offices, but there's also 40,000 wealth managers or fund managers out there. What do you think is driving this sort of growth on both sides?
Yeah, I think on the fund manager side, a lot of it's driven by the fact that companies don't want to go public, and the exit environment for these. I'm sorry, the exit timeline for these companies continues to elongate. I mean, you're in venture, so you know this. I mean, if you look back 25 years, it wasn't reasonable to see a company get founded and then 3 years later go through an IPO. I mean, it just happened. We saw with companies like Amazon. We even saw with companies that were not Amazon that went public on the basis of, back then the rubric was eyeballs. Like, how many eyeballs do you have as a company? And that world is gone, right? So as the bar to go public is incredibly high, and so the private markets had to adopt by, more funds, playing different segments. Every, in venture that could be seed, it could be growth. Private equity started to realize these companies were reaching a size and scale in the private markets that required more capital. And so we saw the supply side, being fund managers, start to expand across segments, across asset classes, and also increase sort of the AUM. Like you look at, publicly traded ones like Blackstone, for example, massive asset managers that generally focus on, providing alternatives to their clients. So all of that is based on the fact that the world has changed. There's half as many companies in the US markets that are public that were in the 90s. I don't think that changes materially.
No,
But
the
if you
alpha is
look at
being created in the private markets for those 10, 15 years. There's still alpha being created in the public markets, but they're all being crammed into the top 7 names.
there's like 7 names, yeah, it's the
Right.
mag sector, right? Generally, and maybe a few on the outlier, but this is not you know, if you look at the small cap, mid cap sort of public company, it hasn't actually done well, and most of the growth in the markets has been driven by a small group of companies. When you look at the private markets, 87% of companies doing over 100 million in revenue are in the private markets. Like, well, somebody needs to capitalize them, so that's kinda growing the supply side. But it also changes the dynamic on the other side of the fence where in the past, somebody like you or I could wait for a company to go public and get access, and there would still be a lot of alpha. Right now, that alpha post public is limited to a small percentage of companies. So, what do you do? Well, you need to think of ways where you as an individual can diversify your risk away from just fixed income and fixed income, very low sort of return rate, public equities, long term, but incredibly volatile by investing across all these assets in the private markets, knowing that there's still a lot of alpha if you pick right. Again, that is the big, qualifier. If you pick right, you pick the right companies, you pick the right funds. Very hard to do. And so wealth advisors have adopted it and said, if we are now going to cater to a client base who's demanding more than just offering an index and needs to offer alternatives, we need a better way to do it. We need technology that allows us to do it. And we may even need access to opportunities that allow us to bring the very best product, but allow them to grow their businesses by getting, people that are affluent people, which there's way more affluent people that are high net worth investors, qualified purchasers, and really, the next generation has been more risk seeking than the older generation that was actually comfortable with 60/40, uh, public and fixed income portfolios. So a lot of these things are kind of driving the growth on both sides, but the rails between the two still are very primitive.
They don't exist. And the technology companies that people made a bunch of generational wealth on, for some reason, the underlying ways in which money got into those investments was still pen and paper for the most part through like legal contracts with lawyers in different major cities. There wasn't really infrastructure to service those investments and also report back and collect back capital and research and all that. And I don't know if it's my Twitter feed or something. It probably is, but the amount of information available out there on the private markets is unbelievable now for a regular person to get caught up and feel like they are learning as much as they can without being somebody in the actual industry. But you guys have gone on a total, run here with the amount of information that you guys are getting access to and the users that you have, getting access through your platform. You've grown in 4 years to over 2,800 users, 2.5 billion in platform assets, 80 plus fund managers, 65 dedicated team members. Talk to us about how technology is being adopted and what Allocate is trying to build as a platform to service this private market.
Yeah. So if we talked about both sides of the market, like the supply side, fund managers, and have the RAs, right? So the RAs are the ones, and RAs, just wealth advisors, private banks, people that cater to somebody else to manage their wealth and, often do other things like tax planning, estate planning. Anyway, the big challenge, for, the group on the demand side, I call that the demand side, is that yes, they know they need to do it, but it's incredibly expensive to stand up an entire, practice to focus on something that might only be 10% of their assets. And so when you think about solving for this problem, you have to solve for them, but in a way that also doesn't create a problem for the supply side, right? And so I'll get into that in a second. So for the RAs, they need to figure out two things to do. Number one is find the right opportunities, right, that are investable so they can act as a fiduciary to their client base and do it in a way that's personalized to each investor, meaning that, man, if I know you're risk seeking and you really want it, I need to know that data and I need to know which funds or which opportunities actually might, fit well with your portfolio versus Samir's portfolio over here, who he's super conservative. I'm just going to put him in private credit. Like the data's there, right? The data on the individual, the call notes, all that information is there. So you can take this two-dimensional approach of not only picking opportunities, but then also matching those opportunities with the right clients at scale without an individual basically downloading it, a complete portfolio, looking at a PDF, spending hours and hours and hours figuring it out when they don't even have total recall of every single data point that's needed to make the right decision. So we do three main things right now. The first thing is we basically do offer opportunities. Again, it's not the core of our business, but the origination part has been important to be able to supply, those advisors that don't have the time or energy to go out and source their own, to evaluate their own. So we do provide that. The second is, creating sort of the technical architecture for client management. If I have a fund that I want to put my clients into, well, subscription documents, KYC, tracking who's signed these things, being able to understand like how does this fit in somebody's portfolio? Well, you have to create technology that makes it easy. So now a wealth advisor can come on our platform, put 150 clients with one click, set up the allocations, and then the subscription documents can be auto filled out. Right? And then I can track exactly which clients are going into it after the investment. I can see how the performance of that particular opportunity, and then we've built integrations with the reporting system, so like they're not manually doing those things. Okay, so that's kind of the second thing. The third thing is the intelligence layer, which I mentioned like the sourcing and value. Well, some of these advisors do see a lot of deals. They may say, hey, I met Ripple Ventures and I really like it, but they don't have the information to really benchmark. So we are creating and we have created some of these tools already, where it's an intelligence layer that sits on top of the data that now can give the CIO the ability to say, okay, Ripple is in the top 20% based on these, metrics. Here's what the cash flow pattern would look like for the clients. Here's what the potential portfolio fit across all my clients might be based on sort of the risk return profile. And what used to take weeks and even months in some cases by analysts are now condensed down to minutes. So really creating that intelligence layer is where we're really focusing as we build this intelligent infrastructure layer for RAs. And for the GPs, they get one, we create the feeder, so they get one LP that they're managing. So you remove all the operational constraints for them.
Yeah, it's amazing because this industry is obviously feels like it's blown up overnight with different slivers of services being offered to family offices and wealthy individuals where you've got outsourced CIOs, offering their versions of what they can offer you from an a la carte or, a fund to funds kind of structure. You've got the sort of just pure due diligence research houses out there trying to comb through the thousands of managers and private assets that you can look at. You've got portfolio managers, right? They're just doing all the paperwork, capital calls, distribution management, taxes, all those things. And then you've got like the multifamily office, which is adding alternatives as part of the services they offer. Where do you see the industry kind of consolidating towards? Because I don't think everybody is going to want to have different service providers at the end of the day. If this becomes more than 5%, 5 or 10% of their assets, like where do you think it's going?
Yeah, I mean that's kind of what we saw. So like for a little bit of background, one of the things that I struggled with when I worked with a lot of the advisors is I didn't have the great client experience. And I realized why I didn't have the great client experience when it came to privates is because they were using like five different solutions and none
Right.
of them to each other. And so purposefully, and it's really tough to do this, but instead of going for a point solution, we said, okay, we got to build an entire sort of layer that allows for the full workflow from discovery all the way to disposition, which is, hey, I've already invested. I might need to sell. I might need to borrow against these assets. How do you create the entire workflow that where you have no loss of data, you have no loss of data across workflows, and you've built an entire operating system that allows somebody to go from soup to nuts to be able to launch an entire platform. Now you have to do it in a way that also understands they may be using some solutions that you have to integrate with instead of like, oh, you have to rip and replace everything out. I don't think that's the right way. I think that's a very difficult play if you go that route. But I do think the world of point solutions as standalone businesses, unless they've already reached enormous scale, is going to be tougher and tougher.
Yeah, I mean, let's just talk about what's happening in the market around you. Obviously, we've got Schwab buying Forge Global for 660 million as, the demand for pre-IPO shares are growing. You've got the Goldman Sachs acquisition at one of the highest multiples for a private asset manager for industry ventures happening. There's a lot of positive momentum happening in the private markets, the secondaries markets. Tell us what you're seeing out there as the public markets and the private markets are essentially converging together with these bulge brackets coming out.
Yeah, I mean, it's a great point to make because there is and this convergence of the private and public markets has been happening for 15 years. It's now at the point though where it's so clear and present to almost anybody and obvious that the private market TAM and AUM is going to grow just to a point where by the end of 2030, the estimates are 30 trillion plus. I mean, that is a massive economic figure. Now, that's across all assets, and not just venture capital, probably at the smallest. But when you think about real assets, you think about real estate, private equity, private credit, there are people that now are even creating derivative products like, GP staking, for example, really, really interesting. Or, I just ran into a fund that, is just doing CVs or continuation vehicles where they're buying assets effectively as secondary. And a lot of these investors are realizing that, that sometimes the buyer is not the public markets, it's another type of fund. And so as you see that, it's just, the 40,000 firms, maybe that doesn't grow materially over the next 10 years, but the AUM will. I would not be surprised if we see more of these private firms go public.
Do you think I was thinking about, like, I think it's $275 billion has been invested in venture this year, I believe is what it is, number around. Is that true?
It's, yeah, I don't know the exact
Because
numbers.
you got the XAIs and the,
Yeah.
OpenAI is taking a majority of it, and Anthropic's, but let's just say it's 275. Do you think the number is gonna grow to 500 billion a year in 5 or 10 years from now? Is that the direction we're going? What inefficiencies do you see in the market on this, in this trend that we need to solve in order to be able to absorb and allocate that capital?
Well, I think a couple things. So, first of all, let me draw a little bit of nuance because I think the definition of venture is still used as what it was 20 years ago. For what it's worth, the big bulge bracket mega funds out there are not just. I would not put them in the traditional bucket of venture capital. Like venture capital, the traditional definition or classic definition is what, like, you invest really early,
Mhm.
and these companies grow at inception. At some point, they grow in scale and they go to growth investors. Now you have investors that focus from like seed, pre-seed all the way to effectively companies pre-IPO that in the old environment would have been public companies years ago, right? It's just the reality. That is a very different sort of business. Like as you get bigger and bigger, most of your capital is going to go into growth assets. You are no longer shooting for the massive power law with those later checks. It's can I get a 2 or 3x within 3 to 5 years. And so I would almost put the vast majority of that 275 as not really venture capital. It's some amalgamation between venture, growth, private equity, whatever you want to call it. And I think, calling it venture capital probably is a little bit of disservice to the, traditional term, and that's okay. I don't think there's anything wrong with it. So what needs to happen? So number one, you need capital to be able to fund these funds that now then fund these companies where we're seeing round sizes. Anthropic's last round was $13 billion. Companies like OpenAI were 30 billion. 30 billion was bigger than all the funds combined raised in 2009. Just to kind of give you a sense of the quantum of capital difference that we're now seeing in the private markets. So what has to happen? Yes, you need a bigger pool of capital to be able to now be able to fund, both the companies,
Mhm.
which it's not going to come from the institutions. There's not a new pension or endowment forming every day. But guess what? There's a ton of new family offices. There's a ton of new high net worth, and the wealth channel is still very underrepresented in terms of their allocation. So, number one, you have to open up the, kind of workflows between the private wealth channel and the private markets. The second thing, you need better liquidity. The reality is, if you are going to really unlock the flows, you need better liquidity mechanisms where if I sign up to a fund, I'm not I don't have to wait 12 to 15 years for my final, check. You need a way to, be able to hit the exit ramp. And we're seeing some of that in terms of financial innovation with like semi-liquid funds. We're seeing registered funds. Those come with some cons, of course. But even if I'm in a private fund, why can't I borrow against that asset in 6 years if I need it? I might somebody has, like people have divorces, they have deaths in the family, they have medical, like these things require you to be able to generate liquidity on demand versus what endowment might be able to do or need actually. And so I think liquidity and just better workflows to allow the wealth channel to participate at scale Because I think if you do that, I don't think 5 to 10% is even gonna be the number. I think it's gonna be closer to 10 to 30% of somebody's allocation that's a high net worth or, family office will go toward alternative investments, and that unlocks far more than that 3 trillion that I mentioned earlier.
Yeah, absolutely. We just went through our first secondary on a fund side, where we had a large buyer come in and buy out existing investors in our earlier funds. We've done secondaries, obviously, through transactions that we're a part of from earlier and pre-seed seed that we're selling at the B or later. So it's a good muscle to have as a GP. But if there's technology that can help streamline the process and make it more available to LPs and GPs, that's a huge win. But I want to go back to your comment about like VC being sort of this overarching name that applies to everything that happens in maybe tech land or startup land. You're right. Like there's buyout funds that are not even as big as the last Anthropic round, right? Are those now venture rounds? Absolutely not. When you've got Fidelity and T Rowe coming in on private companies now, those are not venture rounds. And so you're right. You got to delineate between the two. But I think, technology feels like it has so many different things that it can kind of unravel or uncover the ways in which people view different asset classes. Capitalism is something that I think about as like a massive forest, and there's just mushrooms growing out everywhere, and they're all the just different ideas, the different opportunities, and also the different sort of bespoke options you can have within an opportunity. Right, secondaries is one of those examples or something. How do you think technology plays a role in demystifying a lot of these types of mushrooms that are growing up in the field for people to either research on, get up to speed on, and compare between, because that seems to be the biggest problem. And then maybe include obviously how AI is going to take advantage of that as well.
Yeah, I mean, there's obviously, I would put it in one of two buckets. One is like the discovery, the education of these opportunities. I mean, for folks like us that live in the private markets that have become, kind of either stewards of capital or just become industry like, this is all we do, right? So we understand it. The average person is not spending a ton of time doing those things. They're not, wondering the difference between Ripple and 10 other funds that they manage. Just they tend to invest in who they like, and that's usually how it does. But I think technology can play a lever, especially and I think a lot of people are doing it. If you go on the big AI lab models right now, I can actually upload 10 different decks. I can create a basic rubric of like how to evaluate these opportunities, tell about my situation, and it actually can provide me some incredible like breakdown of like the differences, the pros and cons. So, I'm answering the question on like technology, which is AI is the technology shift that allows for this intelligence layer using all that data that you mentioned is now available to be able to allow people like myself, let's assume that I'm not somebody that spends all my time in private markets, to be able to, find really great opportunities that are right for me. So I think one is like discovery and education. The other one is workflows. Everything still takes too long. I will share an example. I recently signed up for a private equity fund, and they, went through their fund administrator's subscription process, and I almost didn't do it because it was just too painful. Like, and I finally got the manager to kind of go through it with me, and they're like, "Yeah, it's not intuitive." Part of me is like, "This is 2025. Like, I should have like a password with all my information, and any subscription that any manager sends, I should just be able to share my password with them. The subscription doc KYC KYB AML is fully done, and all I'm doing is signing at the end. Why does that not exist, right? So things like that I see as huge sort of levers. Or I want to sell this position. Well, have you ever been through a bid ask? I was trying to sell a fund position or sell a, like it is this dark art
It's worse
where,
than selling a home.
yeah, exactly. So why isn't it such that I can go on something and just like if I want to sell Amazon stock tomorrow, I can sell the Amazon stock. It's one click. I go on Robinhood. Pretty easy to do. I can buy it. Why doesn't that exist for the private markets? Now, there's a lot of reasons, of course, you and I know why that's difficult, and a lot of people have tried. But these are the type of things where I think technology, given the amount of information, and there are companies that are even looking to, hey, how do we reduce the bid ask spread by providing sort of like guidance on, hey, based on the trades that are happening, here's what the buy price should be, or here's what the sell price should be. And then you have market makers that now can create it. So these are all ways where, you implement, technology to solve for either that discovery, the evaluation, or the actual execution so I don't have to go through this painful experience as an individual. Because people like you and I, we grew up in a digital world. We want one click everything. I don't want to go through 100 different, screens and people. And the third is like, transactions, payments and transactions. How do you allow those things to happen more seamlessly?
I still have anxiety going into DocuSign and having to put all the different boxes on my subscription agreements every time. It kills me every time, but we have to do it. And I know there's better ways, but like for us, it's the only way that like some of our LPs will even know how to do it. So I guess a question for you is, you've got a lot of RIAs on the platform. You've got some existing family offices on the platform. What makes them great customers or users? And what do you think the future will hold for some of the best and more forward thinking RIAs who are leveraging tools like Allocate? What will that do for their own business? And I'm asking like for their
Yeah.
customers perspective.
Yeah. I mean, look, every single wealth advisor at the end of the day, their revenue model typically is based on, the amount of assets they're managing, right? So they get a take rate on that to advise on the client, the client's assets. And so what you're looking to do is two things. One is allow them to get more clients, be able to serve more clients, and have higher client NPS, right? So those clients are just happy, they refer other people, and now you have a business that organically can grow without having to acquire, a bunch of other RAs. So the reality is like what we try to do is figure out solutions that allow them to increase the top line, serve their clients better by offering better privates in a way that's highly scalable to this next generation that expects a digital experience, expects all types of different private opportunities, and at the same time reduce sort of the operational need for them to hire a bunch of people in the back office, the front office, where they each person now has all these tools to be able to manage and scale themselves. Like an advisor right now, if I have 150 clients, how many clients do you think I'm actually really focusing on? It's probably 30, maybe 20. What happens to the other 100? Are they really getting the opportunities? Are you really spending time, you know, going deep in what's right for them? You might say yes, but it's just humanly almost impossible to do. But technology allows that. The technology can say, hey, Ripple Ventures, I, as the wealth advisor, approved it. Oh, I have 72 clients that it should fit in their portfolios, and here's why. Here's what it does to the risk return. So, what we try to do is improve their revenue, decrease their costs, and then and by doing that, we allow them to do the things that they're really good at, which is spend time on high value client activities where they can spend time with the client talking about the entire picture and again creating those better outcomes.
Well, people who work in the wealth management space often have the same sort of existing problems we all do. It's the 80-20 problem. They spend 80% of their time on the 20% of the most wealth generating or business generating problems for their customers, right? So if most of your, fees are generated from, I don't know if it's trading or a discretionary book or, some asset allocation strategies you have, you're going to dedicate a lot of your mind share to that kind of services. But what happens if someone calls up and says, hey, I'm looking at some venture funds or some private equity funds. Can you help me look at this? You can't really turn that side of your brain on and just get up to speed very quickly. So that's what you're saying is it allows you to offer more bespoke opportunities and solutions to cater to all your clients and then also potentially find new opportunities that match that existing customer profile that they haven't even been aware of, right?
Yeah, you're 100% right. So if you think about a wealth advisor, for example, there's like a supply chain, the CIO who's kind of looking at opportunities and approving opportunities to be offered to advisors, the advisors who then have to come to speed on these private opportunities, which by the way, that takes a lot of time and effort and, understanding sophistication. Some of them say, you know what, I don't even want to deal with this. My clients aren't like clamoring at first. I'm going to keep them in public equities and fixed income because it's easy. I don't know about this, so if I offer it and it goes wrong, I don't want to be the one losing that client. And then the client unfortunately suffers because of that, because based on their advisor's understanding of the private markets or a certain deal and their fit to that deal, if the advisor doesn't have it, they don't get those opportunities, right? Like, and that's a challenge, for the end investor, because we do believe the private markets are an important lever for long-term capital, and wealth accumulation.
Yeah, absolutely. It wouldn't be a podcast without you answering a question on your thoughts on the venture markets and where we sit versus sort of the movements and gyrations we're seeing in the public markets. The denominator effect is always people something consider, but the quality of companies we are seeing today are like nothing we've ever seen before. The growth is like nothing we've seen. Yes, there is pockets of exuberance and high valuations for spin out lab founders and things like that. And but if you look at the growth rounds, they're actually not that expensive compared to where the top Mag 7 is trading as well. So where do you think we are in the current cycle environment right now? Because it doesn't feel like 2021. It definitely doesn't feel like the tail end of 22, 23. Given where we're at coming at the end of 25, where do you see venture as an asset class right now? And where do you see the opportunities that people are either placing bets on, where they'll perform, and what kind of opportunities and also risks should people looking at the private asset space be considering at this time? Because it is such a long game. So to put a pen in it today is hard, but just things that people should be questioning managers about and getting their opinions on.
Yeah, I mean, there's a lot of, questions embedded in there, so I'm gonna try to
You
unpack,
weave through all of it.
yeah, from the, top level. So, I mean, you're right in that it's not like 2021 with one major, sort of nuanced difference, and that is in 2021, almost every single company was getting a valuation lift, and it was just complete euphoria regardless of what, people were doing. You might remember the NFTs and, it was pretty much everything. Today, most of the euphoria is around, AI, and it seems a distinction between companies that are able to, get really high valuations are typically companies that are AI. If you're not AI, the market is still really, really tough, and it actually feels no different than it did in 23. In fact, I would make the case that if you're a non-AI company, it's actually harder to raise right now than any point over the last, 10 to 15 years. Um, and it's very, very difficult. And there's some great non-AI companies that have scaled to a Series B, a Series C, but find themselves in no man's land because all the energy from those investors is like, what is the next consensus AI company that can be the next, 10, 20, 30, 40, $50 billion company, be it Cursor, be it, obviously Anthropic, everyone knows XAI, everyone knows OpenAI. So it's taken away a lot of the energy for those type of companies. So it's really hard. So it's the extreme version of Tale of Two Cities. You know, you have one part of the market which we have to acknowledge is incredibly frothy, and there's going to be a lot of these companies, probably 90% of them, that never live up to their valuation they receive, and probably exit for an amount where investors may be lucky to get some of their money back. And the application layer is probably one of those areas. And, I do think that the term AR has kind of changed in how people are computing those things. And the switching costs are really low. So yeah, I think there's going to be fallout. But I also think it's going to be completely true that the companies that do make it are going to be a step function and maybe even an exponential step function bigger than they ever have. And we have to underwrite to that.
There's
Meaning,
also companies that are raising a good amount of money early on and never touching that money. I
yeah,
heard a term the other day is called, everyone knows seed strapping. I heard safe strapping. I don't even know if I can say that, but safe strapping, meaning like you have no priced equity. It's like an uncapped note, no information rights, nothing. And the company's barely touching the money because they're growing so fast.
yeah. Although some of that I think is a little bit of a false sort of early signal because some of these companies, you get a lot of curiosity revenue coming in. You have, hey, I'm going to use it, and then people realize like, oh well, Gemini just launched something. I can just go on Gemini and I can now use Gemini or some other model. So I do think a lot of those companies will have to touch the money, and they're going to have to change to figure out what the defensible moats are. But right now, like as a venture capitalist, you don't know who are going to be the winners. You do know that the winners are going to be bigger, and so you have to be able to spread, across a lot of companies, even if it means paying a little bit more. Um, so I do think, yeah, we're in partly a bubble in some parts of the, in some parts of the market, and other parts of the market is it's still very, very difficult. Okay, so when same thing is happening in funds, like the obvious funds, no problem raising whatever they want to raise, like it doesn't matter. In fact, if I look back over the last 12 months, the top funds that we've come across are raising quicker and are getting massively oversubscribed. I've seen everywhere from 2 to 5x subscription
5x
for
oversubscribed.
yeah,
Well, what size
yeah,
of fund are they raising? Like 100 million or 500 million, a billion?
it's all across. So I saw $100 million fund. I also saw a $1 billion fund that was, almost 3.5 times oversubscribed. So like it is happening within the venture market where people are focusing on things that are a little bit more consensus, and that comes with the companies too. You talk about the Mag 7, there's like almost its version of Mag 7 in the private markets. So as a seed manager, I think the world is much, much tougher today because you have mid-sized firms that are kind of series A, where they enter that are, coming upstream and doing seed investments. They can be a little bit more valuation insensitive. And then you have the mega funds that are essentially doing option checks at the seed and Series A, and they can be 100% valuation insensitive. Whether they pay 50 million or 100 million, it really doesn't matter because the business model is the companies that do make it, I can put another 3 to 500 million in this companies and get a 2 to 3x on that 3 to 500. If I get a 10x on that first check, who cares? It doesn't move the needle for my fund. So as a seed fund manager, now you're competing with your fellow seed funds and you're competing with the larger funds who are able to, be valuation insensitive. And a lot of founders are saying, it doesn't really matter if there's signal risk. I'm getting, a valuation that's probably 3x what I would normally get. And I get some signal by having, let's say this brand name Silicon Valley firm on my cap table, which probably allows me to have credibility with my with employees or talent, and with potential investors. I always make the counter argument: you want people on your side at the early stage because you're going to have to navigate through a lot of things. So the seed market, I think, is one where it's less around, am I going to compete against the big firms? But you got to figure out the niche, which either you go really early and you are able to invest before things become consensus. Because in AI, things are becoming consensus really quickly. You see companies going from 0 to 5 million in AR within a year. Again, we can be creative about the AR. We don't know about the defensibility, but that's just the reality of it. So if you're a seed manager, you have to go earlier, or you have to create a distinct niche that is so clear and obvious in terms of what your value add to founders. Is that even when a founder, feels obvious, or the traction is obvious, you still have the ability to win without playing the same game as the bigger investors who are completely and wholly valuation insensitive at the seed round.
Yeah, it's a fascinating, breakdown of how the market is bifurcating between like early stage and sort of Series A plus stage. And we're seeing it totally as well. I mean, we're pre-seed, right? We're inception investors, so at the earliest possible stage to invest. And we have companies that have only raised like, $250,000 and they're at 700K MRR in 6 months. Like real, like I know what you're saying. We didn't believe it until we saw it as well. And we
Yeah.
went through the Stripe accounts and we saw it. And so it is quite wild when you do see it. But then on the other hand, you've got companies that have been through the grind for a couple of years, just trying to get to Series A when they crack 1 to 2 million, and it's a tough time out there for them. I
There's
do
no
think
money.
though, there's no money from the brand name firms for that type of growth. Obviously, like
Right.
2, 3x is not enough. It's 5 plus. But I do find that those types of early years of kind of building and grinding, they harden founders much more for difficult times if and when they do come, that will help them graduate through. Whereas if you kind of leapfrog stages, I feel, and you run into this wall of money, and you haven't had to kind of harden yourself through that, it does become harder. Imagine growing from 5 employees to 50 or 150 and then having to go back down to 20. So that's not easy, and we saw that obviously from the 21 vintage as well. Now, the really interesting thing I think of this generation of companies being built is revenue per head.
Mhm.
I think that that is a very impressive statistic that never really mattered, and now it's becoming much more. Are you seeing that as well?
By the way, I agree 100%. I think capital scarcity is actually a good thing. It creates better discipline in how you run a company, and it forces you to think about things around efficiency, revenue, per person. Yeah, in the past, remember a lot of companies would use one of the metrics of, I have X amount of people. I have 150 people. Now I have 250.
Right.
And that was like a sign of success. Now I think the reverse is true, is like, how much revenue am I generating per employee? And it's, having a 250 person team, part of the question is like, why do you have that many people? Why do you need that many people in an age where you now have access to an intelligence layer with artificial intelligence, where you can do coding faster? You can actually work, internally in terms of information sharing, just execution layers. And so this is all good, by the way. I think the the moment that 2022 happened, it was a shock to the system. People realized that capital wasn't abundant. It created capital scarcity. Now capital is back, but some of the behavior for a lot of these companies is I still want to be efficient. I don't want to burn through it. I don't need it. I might still raise it because I might need it for a rainy day. But if you look at a lot of the companies, they're not burning as much because they don't hire as many people, and people are always going to be the biggest line item in terms of expense.
Totally. We had a company that did the same thing, 21 company raise. Product stalled out, had to pivot, change the product, go to market, cut down to under 10 people, and is now on to 600 in revenue per head. And it's the first thing on the deck that they share at every board meeting is how proud they are about how their revenue keeps going up and their headcount hasn't had to change at all. So it is
Yeah.
very fascinating to see that. I always love chatting with you, Samir, but before we wrap things up, we always jump into our fast favorites. So first off, your favorite podcast.
You mean outside of this one, right?
Of course, this one and Venture Unlocked. How many
Right.
episodes at Venture Unlocked did you start at thinking you'd get to, and how many are you at now?
I had no clue. Like, I didn't know if I was going to do it for a year or whatever. I think I'm at 150 or
It's
so right now.
incredible. It's
Um,
something that you probably never thought you'd get past 10, be honest. You thought you'd
yeah,
do
I don't.
10 or 20.
I thought I thought I'd do it for a year because it was during COVID. I was like, I'm going to do it during COVID, and then I just kind of figured out. I'm like, this is
Hmm.
actually pretty interesting. It's tough to.
Besides both of our podcasts, which ones do you try to listen to at all?
Yeah, I there's a few that I like. So the ones in the industry that I spend a lot of time listening to are probably Acquired and Invest Like the Best. Those are
Mhm.
two that I just found consistently produce really good content.
I'm glad he's doing a lot more video too,
Yeah,
and Jack Altman's has been great lately. He's had some really good guests on
yeah,
Untapped.
yeah.
Next is your Jack is fantastic. He's a natural interviewer. Next is your favorite newsletter or blog.
I don't really read too much, honestly. Running a company takes up all my time, but I do, look, I'm more, unfortunately, probably doom scroll on Twitter more than I should. But it's more just whatever catches my eye, I'll pick up. So I
Twitter's
can't.
doom scrolling algorithm is calmed down a bit recently. I feel like there's actually good educational content you can get into besides like Bill Ackman's like essay tweets.
It's probably the stuff I'm clicking on because I'm still getting a lot of the bad doom. But there are things that are pretty interesting. So I can't say there's a certain blog or anything
All
that I
right.
kind of religiously.
What about your favorite tech gadget or one that you can't live without besides your iPhone?
So I'm wearing it right now. So like I've gotten into this thing where like my wife had finally got me into it, but just, being able to track, sort of my health and wellness. So I finally broke down and bought an Aura Ring. So
Mm-hmm.
that Aura Ring, I look at it, I see the impacts of like the stuff I eat, the stuff I drink,
Yeah.
how it impacts sort of my day to day mood. And I found patterns like actually work for me. And so I do a lot of analytics, just kind of using, sort of
Yeah,
the
it's interesting how much your sleep changes when you have something to drink before, 9 o'clock at night or something.
I mean, you get sleep, but the amount of REM and deep sleep is like it's horrible.
Totally
And I
different.
feel it the next day, even with one drink now.
Yeah. Oh, I had surgery, as you know, on my knee, and so I haven't been able to have a drink for a couple months, and my sleeps have been fantastic.
Yeah, good
Who
for
would have
you.
thought?
Good for you. I'm also trying to cut down for
Yeah.
sure.
It's hard going into holiday season, that's for sure. But the AI coaches they've embedded into their apps, like the Aura and the Whoop app, the AI companion coaches are quite good. You can ask it very simple questions with the data it has on you and give you some pretty tactical advice. So they're getting better and better. We're all going to be the next Brian Johnson. What's your favorite new trend?
So there's a lot of neat trends that, I'm following. So one of the things is I'm actually getting invited to a lot of these events where it's not centered around drinking. So we growing up, you go to an event, everyone's drinking, and I'm finding more like people are actually kind of sober or sober curious.
Mm-hmm.
And I don't feel the pressure, to have to go into these things and have a glass of wine, which actually is kinda nice.
It's
You can
very
just be.
nice.
And it was hard at first, candling. Like, it was really, really hard because I was like, "Hey, I need to drink." I'm used to, holding it at these events. Now, not as many people are doing it. You actually feel comfortable with the soda. You can walk around, and you feel so much more lucid during that day, and then, the next day, you don't wake up feeling like you got hit by a bus.
Yeah, so this literally happened to me last night. I went to two events. First was a cocktail event, didn't have anything, and the second one was a dinner, sit down dinner. And I sat down, and the woman came around for drink orders, and a woman ordered a vodka martini, and my mouth started salivating, and I was like, I can't have anything to drink. I just had surgery, and the woman's like, you don't have to explain yourself. I was like, kind of like defensive about it. She's like, but we have. I was like, do you have what are they called, mocktails? And she's like,
Yeah,
yeah. And sure enough, the mocktail comes. It was the most beautiful drink I've ever seen. They lifted up the glass with the smoke coming out of it. I was like,
amazing.
wow, that's the most beautiful grape juice I've ever seen. But hey, it tasted great, and I felt just as good afterwards, especially this morning. So I totally agree with you. I'm gonna keep trying this out. How about your favorite book?
So there's, actually, I think I have it maybe here. I mentioned, there's a couple books I'm actually reading. One of them actually, I don't know if you know who Danny Meyer is, but he's
Hmm.
a here and, Shake Shack
Of
is,
course,
one of
yeah.
the things. But every business at the end of the day is functionally focused on one thing, which is how do you serve the client or the
Hmm.
customer so much better? And how do you build both a workforce and a process and an internal sort of culture around that? And, I've thought a lot about this even in our business, which we're a technology company. Like the best places you go are more focused on creating an experience, for you. Like the difference between going to a Four Seasons and somebody else. You go to Four Seasons and it's all about the hospitality, and I'm probably a better salesperson for Four Seasons than somebody that works there because they emphasize that over and over, and it was very clear in everything they did, every single interaction. So I started looking at this book and saying, okay, what are some of the parallels of what Danny was able to do with his restaurants, and how do we apply that as a company in infusing it within culture? And actually, one of the things that we have is extreme client service, right? Like that is we have two core values: relentless problem solving and extreme client service. And everything is embedded. Like, did you do something that provided extreme client service? What does that actually mean? And what you find out is the definition of what great client service is ranges so broadly. Ranges so broadly. But if you raise the bar on what you should deliver to somebody, and then understand that people are at the end of the day just human beings. They want a great experience. Doesn't matter if it's software, doesn't matter if it's staying at a restaurant or going to a restaurant or going to a hotel. So implementing those things has been really interesting. So I really like that book.
That's a great suggestion. It's kinda like your concept of, like, how you almost didn't sign up for the private equity fund because the process was so bad. It had nothing to do with the investments they were gonna make, the return they were gonna have, but that customer experience of signing on as an LP was so frustrating to you that it almost threw the entire relationship out the door, and I can see that with our own LPs in the ways that they like to be communicated with. Some don't wanna be communicated through physical reports. They wanna be, video calls, or they wanna meet you for coffee once a quarter. Everyone has a different experience level they expect or hope for when having an economic relationship, and you got to blend yourself into that. And that's a great suggestion. Definitely going to check that book out. Last but not least, is your favorite life lesson.
God, I have so many life lessons. I mean, part of this is I've just made so many mistakes in my life. But I think, one of the things, that's really I've always focused on is when I was younger, especially in my career, I used to look at everything, as part of, like, short sprints. It's like, "When do I get the next raise? When do I get the next promotion?" And it actually forced me to index on the wrong things. And even when you build a business, if you focus on, like, "I need a growth rate of 13% next year," or I'm sorry, next month to get to 74%, and this is what's gonna define success, it forces you to think in a way that, probably isn't right for the long term. And so everything I do is now thinking in terms of the next 10 to 15 to 20 years. And so when I make decisions, for example, at the company, I don't, when people are like, what do you want your growth to be next year? Like, of course, I have something in my mind. But more importantly, it's like, what are we doing to solve the client's problems? And how do we, create, continue sort of like patterns to, again, in Danny Myers thing, set the table for these people because we got to make decisions on the long term, not the short term. And so I would just say, like, life is short, but you still got to think long term when you are making decisions in your life. And, these things become compounding. Just like I mentioned on the aura thing, like some of the things I'm doing right now will be most impactful 30 years from now, how I
It's
feel.
so it's so impressive to hear you say that. It's almost like, when they show like a snapshot of a stock chart on CNBC. It's like, look at the move in this stock. And you're like, that was from Monday to Friday. Can you zoom out, please, for like 5, 10 years and just show me what this actually means for people who are not really interested in the next 5 day move, but maybe the next 5 to 10 year move? And people should look at their lives sometimes that way, and it will even out the spikes and the drops as well, so that you don't have as much of an emotional or visceral reaction to the positive and the negatives, right?
That's right.
Yeah, it's
Totally
awesome.
true.
Well, thanks for joining us in the tank today, as always, Samir, and congrats on the recent Series B raise.
Thanks so much, Matt. And it was great seeing you and happy Thanksgiving.